Hello, everyone. Thank you very much for joining us today for this event on funding routes and equity. We have the marvelous team here from Addleshaw Goddard who are going to do a presentation for us, and there'll be time for a Q&A afterwards. Following that, there will be a networking lunch. And if you are interested in signing up for office hours, the team will be staying on for the afternoon to answer any questions that you have about funding routes. My name is Gardner. I'm Head of National Community at CodeBase, and I'd like to welcome you all to the Eagle Labs today. And a big welcome to everyone that's dialing in from home. We have Narette Phones, who is our online host for today. So if you have any questions, please pop them into the chat, and Narette will let me know, and I'll ask your questions during the Q&A. And a very thank you to Costas, who is our tech support for the day, and Marge, who's hosting us at Eagle Labs Glasgow. No fire alarms are due to go off today, but if they do go off, if you could please exit the building through the door you came and gather on the corner opposite the building. And that's all from me. If you have any questions, please keep them for the Q&A. And I'm going to hand over to the team now. Thank you.
Thanks very much, Kelly. Good morning, everyone. My name is Anna Brown. I'm a corporate partner with Addleshaw Goddard, and myself and my colleague Sam are delighted to be here this morning to talk to you about some funding routes. Delighted to be working with Barclays, Skyscanner, CodeBase in relation to this tech scaler event. My background is corporate work, so for over 25 years I've been advising companies of all shapes and sizes on a variety of corporate matters, everything from starting up their business, raising funds, buying and selling other companies, reorganising things, exiting, doing a sale process, floating them on the stock exchange, doing joint ventures, so a whole range of corporate matters. In relation to Addleshaw Goddard itself, we're an international law firm. We've got offices, 6 offices in the UK, in Ireland, in Europe, the Middle East, and Asia, with desks that also cover South Africa, South America. So it's a full service law firm which covers, a wide variety of things that most clients will need. We've got about 1,600 lawyers globally. There's about 350 of them are partners, covering a variety of sectors that kind of usually covers most people's business needs. We're very client focused. We want to sort of deliver solutions and make an impact to your business, and be very commercially focused in answering your questions. We don't like being, no, you can't do that. It's how can we do that and staying within the confines of your regulations. We are number one in our fielders. We have got about 40 number one rankings in each of the different sectors that we operate in. And we've also got the FT award for 4th most innovative law firm in Europe. So what? I can hear you all say, what on earth does that mean for me? Well, it means that we can generally assist most clients from really tiny startups. We run an AG Elevate program. Happy to chat to you about that, which is geared for growth companies where you can get some legal support and mentoring for your business to help it grow and develop and take on to the next stage. We also, CSR, sustainability, diversity inclusion is also key for our businesses in all areas. So I say we're very client focused. We're delighted to be here today to be speaking to you. If you have any questions, please just shout as we're going through. There'll be a separate question and answer session at the end. But if you do have anything, I know it's always difficult to remember what they are as you work your way through. So feel free to interrupt us as we go through. If we start talking in jargon or acronyms, stick your hand up and say, I have no idea what you're talking about. And we can explain what that means, because it can get a bit jargon-like. So Sam will tell you a bit about himself as well, and then we'll get started.
Yeah, just a bit kind of brief introduction about me. So my name is Sam Lawson. I'm a managing associate in the corporate team at Addleshaw Goddard. And just like Anna, I advise companies at a range of different stages on all aspects of corporate law. And I guess a typical day in my working life will involve advising the founders of businesses, like many of you here today, on their investment processes, and also sitting on the other side of the fence advising the investors on their investments into those companies. So very much have a kind of understanding and appreciation of the challenges that you'll be facing and the topics that we're going to cover today.
And those topics are the types of funding that you can get, with a real focus today on sort of equity fundraisings. That's you issuing shares in your company to investors who are going to back you. We'll look at the investment process, an overview of it. We'll look at some of the things to think about in relation to your investment, what you need to think about and what your investors are going to be looking at in relation to your business. And we'll also have a look at some of the common pitfalls that would be useful to avoid, or at least navigate your way around as part of this process.
Yeah, and I think it's worth saying as well that we'll be looking at this from the perspective of founders, rather than from the perspective of investors, although we'll try and give you some insights into the kind of things that investors will be thinking as you're kind of navigating these challenges. So if you look at the different types of funding, super back to basics, high level, I guess we've got equity funding, we've got debt funding. So equity funding obviously involves the giving away of a portion of the business in return for usually cash investment, whereas debt funding involves the borrowing of money. So typically businesses at kind of all stages might have a combination of both of these, but there's advantages to both. The advantage of equity funding is that the investment comes with no repayment obligation, whereas the advantages of debt funding is that you don't have to give away a portion of your business. So really, companies will have a choice about what source of funding they pursue, but generally we see companies at the age and stage that we understand many of you are at pursuing equity funding. And that's primarily because the ability of a company to source debt funding will be dependent on a number of things, including existing financials, creditworthiness, and financial covenant, which are things that might be problematic if you're at the fairly embryonic or early stages of your business. So today we will be very much focusing on the kind of equity funding route. There are, of course, some grey areas and some, I guess, nuance in there, and that you might see a combination of equity and debt funding. You might have heard the term convertible loan notes, which is where there is an obligation which starts out its life as a debt, but then may be converted into equity on the occurrence of certain events. You might have also heard about warrants and options as well, but we'll be focusing on equity funding very much today. And in doing that, we'll look at a typical investment process from the point of view of the company. We'll look at two parts. So Anna's going to deal with investment readiness and making sure that we're fully prepared to start and complete an equity funding round. And then I'll take a look at the legal bits, which is executing the deal.
Thanks, Sam. As far as investment readiness goes, we're just going to break that down into sort of three areas. Seeing the bigger picture, which is really you looking out a little bit more at what you need to be thinking about, what the investor might be looking at if they're going to invest in you. Some internal preparation. There's some things that you will need to do to get yourself ready to receive investment, to make you the most attractive as you can be for those investors. And then third-party considerations. So there'll be some things that you need to do, some consents that you need to get. And it will depend at the age and stage of the company, whether you've got investment already, whether you haven't got investment, who's backing you, and some of the consents that you need. So looking firstly at sort of seeing the bigger picture, some of the main things to think about are what's your story? What is it that you're asking the investors for? What are you selling to them? What's your elevator pitch? Why do you want them to invest in you, and why is it a good opportunity for them? Investors will be looking at two key things. They'll be looking at the business and the product that you're selling and the opportunity for that. And they're also looking at you and the management team. Do they like you? Are you going to be able to deliver it? Are they interested in you? So there's kind of two key elements to that you're looking for. It'll also depend on the stage of your journey. What are you looking for the investment for? Do you need premises? Do you need to expand the team? Do you need to money to protect the IP that you're developing? Do you still need to do kind of testing of that, scale ups, prototypes? Do you need to go into a new market? Are you going into another jurisdiction? So there'll be all manner of reasons why you need the cash to develop your business. So you want to be looking at what it is that you're looking for the money for. What's the market like? Understand your market. What's the competitors? Are you going to be first there with this fabulous new idea, new product? Is it a heavily congested market where there's lots of competition? How's that going to work with pricing? How are you going to distinguish yourself from the crowd? Is the timing right? Is it too soon? Do you not have your IP developed, your product developed sufficiently for the stage where that is developed, and you're going to be able to moving on to the next stage? You're going to be kind of looking to sell. So it really depends on what stage you're at. Do you need to expand your team? Do you need other advice? Do you need sort of non-executive directors or other guidance to help you? Most people start on their own with a group of friends or colleagues, people they've been at university with, people that have been in other businesses with, and they've got this great idea. Do you need other people who've got a bit more grey hair, who've done it before, who can give you the benefit of their experience and how they've tackled those challenges? Different, as Sam will come on to, different investors will be able to contribute that. Some you might just be looking for the cash and to leave you alone. But also think about what's the investor going to get back out of it. When you invest in equity, it's right, you don't repay the equity like you have to repay a bank loan, but the investor is still looking for a return. It's not a gift to you. So how are they going to get a return on that? Are you going to sell for millions? Are you going to get regular revenue streams that they're going to be able to take dividends and take money out of the company regularly? So how are they going to get a return, and what's the sort of time scale that you might be operating to, and see how that matches with your investors' requirements? So that's a bit of the kind of the outward focus of the process. Looking at the internal arrangements, there's lots that you need to do sometimes before you take investment, and it's the same with any kind of whether you want to buy the company or sell a company. There's lots of diligence and things that you need to do first of all. Who are you going to get investment from? There's a whole myriad of investor groups, individuals that you can get funding from. There's angels and high net worth individuals who are generally people who have been in your position before. They've set up their own businesses, they've scaled them up, they've sold, and they're now reinvesting their sale proceeds in backing the next generation of businesses. As we'll come on to in the next slide, there's tax advantages for them in investing. So the government encourages certain types of investments into kind of startup tech companies, knowledge-intensive companies. Crowdfunding, you can get crowdfunding organizations where people will kind of club together to invest in something, and there's different formal and informal arrangements you can have for that. Specific venture capital private equity firms, and they will all invest. Usually people have got a range of investments that they want to, how much money they want to deploy. So if you're only looking for a small amount of money, so if you're hundreds of thousands of pounds, you might go to one type of investor. If you're looking for millions of pounds, it'll be different types of investors. Corporate investors, if you're in a particular area and you get support from, a kind of large organization or company that's backing your product, you can get investment from them. Scottish Enterprise supports most growth businesses in Scotland, and they'll usually piggyback with a range of the investor groups, and that helps you to effectively double up the funding that you can raise. At the other end of the scale, some people float on the stock exchange, and you can raise money from that. So that's not at the startup stage, but that's when you've grown your business that you can raise money from that. Think about the issues you need to tackle and minimise the problems. If you've got any issues that you're worried about in the business, if there's anything festering away in the corner that's a problem, you think, I can't face it, I can't deal with that. Neither will the investors. They want, if there's any kind of issues, try and identify them, try and deal with them, or at least know how you're going to deal with them. You might need money to be able to deal with them. Lots of businesses will not have formal legal documents for everything. You're too early, it's too expensive to do that. They'll want you to focus on some of the key things. Have you protected your IP? Have you got somebody to design it and they've kept all the rights? Have your employees or students that you've got involved in assisting your process, have you got them to sign up to say, actually, I'm doing this, but you get all of the IP? There's a bit of housekeeping that you would be wanting to check and try and close down those gaps and those loops. So IP leakage is one of the key things that investors will be looking at. They don't want to back someone if actually you don't actually have the rights to develop the product. who's the team that's backing you? One of the things that people underestimate is how much time it can take to raise money, and your focus can go off the business and the day-to-day development work or sales work or whatever it happens to be, because you're so focused on the investors, and that in itself can impact on your investment progress. So make sure you've got a bit of a team, or how you're going to be able to get some support, and you can sometimes get that through your kind of advisors and kind of other people who are assisting with the process. But yeah, identify where there are issues and gaps, and try and plug them before you're selling to the investors, because they'll spot them and it could impact on your value. And then third-party considerations, as we talked about, for a lot of the investment at the sort of startup stage and the growth stage, you will be looking at sort of angel investors and different investors who will be looking at tax advantages of the investment. So they get tax breaks from their income tax, they get tax breaks from capital gains tax if they sell for a profit. There's different levels of that. SEIS, the sort of the seed funding. That's money up to sort of £250,000. The type of company and the size of company and its assets will determine whether that funding is available. That then moves on to sort of EIS, Enterprise Investment Scheme, where you can raise larger sums of money, and there's different tax breaks for your investors. VCT investment, again, similar breaks for the organisations. You can invest in that, and it just encourages those types of investors to invest in your kind of business. You need to get clearance for that. The Inland Revenue needs to say, yep, you're the right type of company, you've got the right headroom for this, to get the break. So there'll be a timing issue on being able to get that from your investors. On EIS as well, they would usually want to get EIS clearance. Sometimes they'll invest, if they think it works, but more often than not, your investors are looking for you to apply to HMRC, or your accountants to apply to HMRC to get that confirmation, so they know they're guaranteed to get the tax breaks from their investment.
How do they look at insurance stage? CIS, is that something that they say is guaranteed, or?
It depends on it depends on the investor. It depends on how certain they are of it. If you need the cash or you're going to fall over, the investors take a different view. But a lot of them will want you to get the actual clearance, so they're certain of getting there.
So when it's clearance, it's the same as the advance assurance, right?
Yes. It's advance assurance. Yeah, it is. It's the advance assurance.
Yeah, and it's worth remembering as well that depending on the investor, sometimes if you've got a sophisticated investor, a VC or private equity, they'll be managing other people's money, and they'll have made commitments to those people that the funds that they're investing will receive the benefit of EIS or SEIS relief. So that's why for them that might be a go no go in terms of, does it have advance assurance or not? Are we completely comfortable? So yeah, it's definitely a critical item to make sure you've got in place.
So once you have advance assurance,
yeah, the companies, there's kind of forms and submissions and things that need to kind of follow on from that. But yeah, at least it'll tick the boxes to say the company's eligible.
Yeah, and it's worth mentioning as well, I think that gives you that kind of certainty at that point of time when the investment's done. But it might be that at each investment round, investors will look for you to get advance assurance again from HMRC. It does get much easier at subsequent investment rounds if HMRC have given the clearance before and they're comfortable that there haven't been any changes. The process does get quicker. We did one recently where I think it took 2 weeks to get advance assurance on the basis that nothing had really changed with the company, and HMRC can process it fairly quickly.
Also for every.
Yeah, usually investors would look for that in our experience, yeah. I mean, some, as I say, it very much depends on the investor, but if they're managing other people's money or it's an EIS fund, they usually will. But if it's an angel group or a slightly less sophisticated investor or a slightly more kind of an investor that's got a kind of bigger risk appetite, they might be happy to say, okay, we're comfortable that we know the business, we've been fully involved, we know that nothing's changed, so we can be comfortable that it's fine. But it's better to just go for it in each case, because that way you don't delay if people ask for it down the line.
Another sort of regulatory approval, the National Security and Investment Act, getting very technical, was introduced last year, and what that does is kind of a government trying to make sure that sort of sensitive sectors and sensitive businesses within the UK don't kind of disappear off largely into sort of foreign ownership. Tends to cover acquisitions that people are looking at. So if you buy 100% of a business, then you're taking control. But actually, it does impact on investment work. So whenever you come to do an investment, if you're in particular sensitive sectors, and there's 17 sensitive sectors under the Act, or your investors are going to be going through certain percentage ownership bands, control bands, so 25%, 50%, 75%, then you either you might need to notify or get a clearance in advance from the government to for that investment to go ahead. Transaction is void if you don't get it and you need it. So it's now one that's kind of everyone is kind of agonising over for all the investment work. So it's something to bear in mind. Again, that has a timing as an initial 30 days clearance process for that, which can be extended depending on the sectors. Sectors are some of them are quite obvious. It's like defence, some technology stuff, data. There's a variety of different sectors that kind of fall within that are sensitive. That you need to have a look at. So it's another sort of external clearance that might be required.
Yeah, it's maybe worth saying as well a couple of things. The sectors, on the face of them, they look fairly clear in terms of defence and things, but actually the drafting of the legislation it's not really, but it's quite wide, so it could be interpreted to catch companies that don't think they should be caught. And we're also seeing investors having a preference for the company doing a bit of analysis as to whether it applies when they get involved and they're doing their due diligence. So if you're going through the steps of preparing for investment, it is worth taking a look at it, doing a bit of analysis yourself, or asking your legal advisors to at least give you an initial view so you can present that to the investors. It just takes one thing off their plate in their approval process if you can at least do a bit of work on that.
No, it's separate from your advance assurance. So that's just telling you how if you've got the right kind of company that's the right size for the investment. The capital, the share capital sheet. Once you're looking at the investment, you would then be looking at what size of investment. So if somebody said, "I'm going to take 50% of the company," they've got an element of control in there, for that could bring them within the confines of the NSIA regulations. So it's
fluctuated down at 21%,
then you're kind of below those thresholds. So that can impact, and it is part of the wider discussion on how much equity you're giving away, what money you're getting in, how many different investors there are, and are they all below different thresholds. So it's just something else to keep to bear in mind.
A question has come up online sort of in relation to this, and it says, do you have a deadline to use the SEIS before it drops off? I obtained mine 2 years ago, but I'm still pre-revenue and only now starting to raise.
I can't remember the exact date for how long your clearance lasts. It's usually about, I'll not say a time, but there will be a time period that you get your clearance. There is also a time period for when you are kind of once you start revenue generating, you've got a kind of 7-year window typically to be able to kind of use the sort of EIS type investments. But in terms of the actual, I've applied for it, I've got my advance assurance, how long does it last for? It probably says it on your letter, but the tax guys will be able to give you kind of clearer guidance on that. But it will. There will be a kind of a period that would need to be invested in.
Yeah, and it's worth being careful as well, because I suppose 2 years is a fairly significant amount of time, particularly for a startup in its embryonic stages. So it wouldn't be surprising if there were pivots or other things happen in that 2 years. So yeah, even if you're within that time period that will be on the letter, it's worth revisiting it to make sure that your business has not changed significantly at that time.
Any other conditions, for example, if you have got any bank funding or anything else, they might say if there's investment, or if the management team changes, or if there's a sort of change of control, so somebody gets control investment, then you need their consent. you will invariably need consent just from the other shareholders of the company, because you'll need approvals to issue more shares. You'll need to adopt new articles of association, which contains all of the investor rights, and kind of Sam will talk about them as you go through. So you'll need to build that into the process as well, and it depends on whether it's just friends and family that you've got in your group at the moment, whether it's you've already got some investment where you need that investor's consent. You might have spun out of a university and you need university's approval to do some things. So it's worth checking your sort of constitution type documents just to see what other consents you need. And if you've already got some other investors, there'll be preemption rights as well that you will either have to follow or disapply, where they get first dibs on any new shares that you issue, or on a kind of an ultimate sale process.
Yeah, and just watch out for, in terms of consents, watch out for people sneaking clauses into contracts where you wouldn't necessarily expect it. We had one last week. We're dealing with an investment for a spin out, and one of their customer contracts, it's a kind of proof of concept contract, and it's got a clause which says that if they want to raise any investment from anywhere, they need to give them kind of first dibs on it, which I don't think anybody really had been cognizant of until we looked through the contracts. So it is something to be aware of, because it throws a wee bit of a spanner.
Deal process.
Okay, so deal process. So assuming you're fully prepared and you're ready to kind of embark on your equity funding round, we'll just take a look through what the deal process looks like. So usually once you've ready yourself for investment, you've identified the investors that you're looking to pitch to, you'll have submitted probably quite a number of different pitches and applications to different investors, and all being well, that'll be followed up with a number of meetings and presentations for you to tell investors a bit more about your company and your business and what your vision is, and allow them to kick the tires and decide whether they want to go further. And on the happy path, the outcome of that really should be for you usually a set of heads of terms from the investors. Now, we really want to encourage you to push investors for a set of heads of terms for a number of reasons. The first is that so that there's certainty over what the terms are, to make sure you're aligned. But the second reason is really to make sure that they're serious. It takes investors quite a bit of effort to put together an investment case and go through their informal approvals in order to get heads of terms out, so you can be confident that once you've got a detailed set of heads of terms from investors, that they are serious and they are going to pursue it, and that both parties can really start putting the time and effort into the investment process that they need to.
That comes from investors. So
typically, yes, although you bring me on to my next bullet point, so thank you very much for that. Auction processes, auction-ish type processes. So usually you look for investors to give you the term sheet, but if you've got a particularly hot product and you can create kind of a competitive environment, sometimes there is the opportunity for you to drive the terms. So I think the best example we've got of this, we acted for a successful Dragon's Den contestant, if we call them that. We did an investment with the Dragons, and then following that and their subsequent investment rounds, they were able to build on that success, build a lot of hype, build a competitive environment. And in effect, we went out to investors and said, these are the terms, these are the timescales. We've got a great opportunity here to invest, but if you want to take it, you better grab it, and you better grab it quick. So if you do find yourself in that kind of fortunate scenario, it is worth taking a step back and saying, actually, am I in the kind of lucky position where this is something that I should be doing? But generally, we would expect investors to be driving that. So yeah, we just put that out there just as something to think about.
And you may have a group of investors that might not just be one investor. You might have a kind of package of they're all going to come together to raise the amount of money that you want. And as you see, you'll quite often have one group of investors, whether it's angel investors or kind of private equity investors, and Scottish Enterprise will co-fund with them. So you'll double up the money. So there'll be a different group of people, and you could have, any number of, the angel investors tend to work through one gatekeeper in terms of the documentation, but you'll have a group of investors, just depending on how much you raise and how much everybody is prepared to invest. Yeah. And that can get more complicated when you're looking at term sheets, because they've all got different requirements, and you're just trying to kind of piece them all together and make sure you kind of come out on top at the end. Yeah,
that's right. And I mean, once you've got those terms, you do very much have to go through the exercise of comparing investors. If there's more than one, you need to do your due diligence on them as much as they're going to be doing due diligence on you. A few things to watch out and be aware of. Those that have got no capital yet. So, you might get involved with an investor, you might get further down the track and find out that they've not actually raised the big fund they've been speaking about, or they don't have the finances or the cash ready to invest when you need it. Or they might have particularly long approval processes that don't work for you from a timing perspective. Changing deal terms is a big red flag for us. So if we see a constantly changing set of deal terms, it's a red flag that potentially the investor's not sorted their business case internally, they've not got the right approvals, and that'll make things very difficult for you to go forwards. Understanding the arrangement and monitoring fees from the beginning. So investors will often charge arrangement and monitoring fees. So an arrangement fee, I guess it does what it says in the tin. It's the fee they charge for arranging the investment funds. That's typically a percentage of whatever money that they invest, and that'll be taken from the fees from the investment amounts at completion of the investment. And then monitoring fees, usually it's an annual fee that the investor charges for, I think the justification is to cover their costs and expenses in monitoring their investment. And again, that'll be a percentage of the funds usually that they've invested. So it's important that I guess you get alignment and full kind of transparency from the investor of what these fees are up front. Penultimate point there. So does the investor's goals and timing align to the company's goals? So this is really a key one. I think it can be really, the tendency can be if you've got cash on the table to grab it, but actually you need to take a step back and consider, does this investor want the same thing that I do, and are we aligned? If they're a particularly aggressive investor and they want an exit in 1 or 2 years and you're not there and you've got a longer term vision for your company, then it's not going to work. And exclusivity, so this is something that will usually be contained in the term sheet, but often investors will look for you to commit to them once you sign a heads of terms, and not, I guess, seek investment from other places. And the justification for that is that once they've signed a set of heads of terms, they'll very much mobilize their machine usually to start doing due diligence, and they'll appoint lawyers, and all of that costs money. So what they don't want to happen is for you to pull the rug under their feet. So really the flag is that if you do see exclusivity terms, you're minded to accept them, to make sure that you're comfortable with what they cover and the timeframes. Particularly if you've got a requirement for cash and you need it quickly, you don't want to have a really long exclusivity period that binds you to one investor just in case things don't work out. And we'll come on to that later, which is the need to have a plan B. And lastly, beware the detail. Seen this a couple of times actually in the last couple of weeks, where we haven't been involved in heads of terms, but we've been presented with them in order to progress the legal paperwork. And we've spotted terms in the heads of terms, and we've said to either the founder or the investor, so that term looks a wee bit funny. And they said, oh, I don't think I saw that. But once it's in the term sheet, although often they're not all legally binding, it can be very persuasive and very challenging to back out of a term that is contained in the heads of terms when you come to do the legal documentation. So yes, beware the detail. Oh, and lastly, due diligence. So once you've got a set of heads of terms and you're signed and you're ready to commence the transaction, the investor will typically commence proper due diligence. It might be when you get to, before you get to heads of terms stage, that they've already started doing usually financial and a wee bit of commercial DD to make sure that your company is one that they're interested in investing in. But it's really only once you've signed heads of terms that they're generally okay committing to doing proper legal and tax DD if they want to do it. And the reason for that is just that it is quite expensive for investors to do that. But you should make sure before, if you're doing any DD, before you've got heads of terms signed, that there's a proper confidentiality agreement in place. And sometimes that's contained in the heads, but if it's not, you should just make sure that you've got one in place from the outset. Exactly, yeah. So there's fairly standard NDAs, and they're usually not controversial. You might have an NDA from an investor, but it is sometimes helpful if you've got your own NDA on the stocks that you can give to investors before you start discussions. It really drives the right behaviours, and it's quite a good thing from an investor to see if they can see that you're set up to do the investment round. You've thought about it, you've already put the work in to have an NDA, and you give it to them. Yeah. So I think usually you'd want a fairly specific NDA that just covers, usually it's the purpose that's the key point of an NDA, and that's what restricts how they can use the information that you give to them. So you'd be looking to define that as narrowly as you could, and really the purpose for them should be evaluating making an investment into your company.
The rest of the terms will be fairly standard, but as Sam says, it's what's it for, what are you using it for?
Yeah. It really does differ, to be honest. It differs based on the negotiation position of the parties, but sometimes arrangement fees kind of 5-ish% usually, and then monitoring fees 1 or 2. But yeah, in terms of the monitoring fee, sometimes it depends what the investment amount is. Obviously, if the investment amount's huge, a percentage of that might not necessarily make sense, but yeah, it's usually around there.
And it might be the cost of a non-exec director going on the board. So that sometimes is the sort of the fee that you will cover instead of a monitoring fee, or you might have both.
Yeah.
It might be a bit of a silly question, but when do you whip out the NDA?
As soon as before you give them any information about the business. Yeah.
Because some experience.
Yeah.
Yes.
It's no bad thing for you, because what you're doing is, if you look at when you get to the investment, they'll ask you, have you given any of your information away without it being subject to confidentiality agreement? And you'll say, well, yeah, to you, because you wouldn't sign it. So it as Sam says, it drives good behaviours. You're getting your house in order. So we would always recommend that before you give them any kind of key financial information, if it's a company's house and stuff like that, that's different. But if you tell them anything about your kind of business, anything that's key, it just drives good practice to get them to sign it. It shouldn't be objectionable.
Yeah, it also demonstrates that you've got value in your company as well, because you want to be saying to them, look, these are my crown jewels. They're worth, I think they're worth a good amount of money, so I don't want to just disclose them to anybody.
Just like an online thing. A startup or startups have got loads of money to go into your offices and say, hey, I'm prepared to pay the big lawyer fees. The key is, what are they going to use the information for? That it's all remains yours. They can't use it for anything else. As soon as they finish the discussions, they destroy it. They hand it back. They hand it back to you, and they've got no rights over it. So it can be quite simple, but that's kind of the key things you're wanting to cover. And if they pass it to anyone, it needs to be within the confines of confidentiality as well. And they can get it back from them, whether it's to their advisors or something. But yeah, you want to it can be kept quite simple.
Yeah, and it's also something as well that if you don't have that, or you've not engaged legal advisors that you can call on to give you that, and you've not found one online you're comfortable with, and you could say to the investor, look, could you send me across the NDAs that you use with your investees, and I'll take a look at it before we just commence discussions, because they'll certainly have them.
Be to get the point where it's not big conflict, but we were looking at and separate one NDA and
and you would just roll out the same one for most other circumstances, and just change what they're using the information for, whether it's negotiating a contract or for an investment or a sales process, whatever it happens to be. You just make it focused for that particular purpose.
Yeah, and it's worth making sure as well, although we're lawyers and we like contracts, I think there is an acknowledgement that NDAs are quite difficult to enforce, because ultimately the burden of proof would be on you to prove that an investor had disclosed something that they shouldn't have done, and that you'd caused losses, and that you'd suffered loss as a result, which would be quite a difficult thing to do in practice. So the key purpose of it from a practical perspective is to drive the right behaviours and make sure that they know that they're not supposed to be disclosing it. But really, I think our advice would be that you protect yourself as well in sense checking what you're disclosing and at what stage. I mean, you don't really want to give the crown jewels away at any stage to anybody, even if you've got an NDA in place.
I mean, so maybe they want to do customer diligence, but you don't want them to speak to the customers until you see the whites of their eyes and the checkbooks on the table. So there's different times that you want to do that, or if it's really, really sensitive IP and technology, and you've got a particular manufacturer that that it is secret, you don't give them those details until right at the very end. It happens the same in a sales process. So it doesn't say, okay, here's all the books. You can feed them on different basis, and once you start the diligence process, they'll have questions and they'll ask for more. But understand yourselves at the beginning what's fundamental, that if somebody else got it and used it would be detrimental to your business, and engage it that way.
Yeah, I mean, things like IP, you can give them a description of what your IP looks like without giving them code. I think it's the flag. Code, if you've got a software business. Okay. Also, I'm just conscious of time. We'll keep moving. So once we've done all the prep, we've got terms, we've done VD, we need to get into documenting the transaction. So in terms of the structure of what that looks like, it'll depend whether this is the very first investment you've done or if this is a subsequent investment. So if this is the first investment that you've done, we'll be starting fresh with all new documents. Often, if it's a sophisticated investor, they'll have their own set of documents that they'll want to use, which they'll push onto you, which is quite difficult to resist sometimes. But if you're in a strong position, if you're in one of those auction processes that we mentioned, it might be that you could push your own documents, but generally it will be the investor that produces them. And then when we talk about investment documents, we'll just run through what the kind of core documents are. So the first being the investment agreement. I'm sure that's a term that you will have heard, and some of you may have investment agreements in place already. So the purpose of the investment agreement is really to do two things. Firstly, it'll deal with the mechanics of the investment. So it'll deal with the investors paying the company cash and being issued shares. And secondly, it will deal with the ongoing relationship between the company, the founder, and the investors. It'll contain the key terms from an investor's perspective in terms of what controls they've got over the company. So do they have a right to put a director on the board? What information rights do they have? Are there a list of matters that you need to get their consent to do? And those are all the kind of hot topics that are usually negotiated in an investment agreement. The Articles of Association. So every company in the UK has to have a set of Articles of Association. That is in effect the company's constitution. It contains the company's rules and the rules that govern how the company is operated. Those are publicly available. They must be registered at Companies House so the public can view those. And they'll contain key terms around things like the issue of shares, the transfer of shares, what happens if there's a capital return or a liquidation event, director rights, board rights, how board meetings are conducted, how general meetings are conducted. So they're very much a kind of key critical core document that'll get negotiated. So the disclosure letter. So not sure how many of you will have looked at a disclosure letter before or been through a disclosure process. Just to summarize it, as part of the investment and an investment agreement, investors will usually look for a suite of warranties to be given. And warranties are contractual promises that are given by the company and usually also the founders to the investors as to the state of the company at the time that they invest. And the suite will usually be pages and pages long. It'll cover everything from IP, IT, litigation, share capital. And really there's a few ways that we can protect the company and the founders from possible warranty claims, because in the event that any warranty turns out to be untrue, investors may be able to bring a claim against the company and the founders. So the ways that we protect the company and the founders, really two key ones. One is inserting limitations into the investment agreement. So we might cap the liability of the company and the liability of the founders personally. But the second key way is through disclosure. So to the extent that there is any fact, matter, or circumstance in a warranty that is going to be untrue at the point of the investment, we can disclose those facts, matters, or circumstances to the investors, and that will prevent them from bringing a claim. In effect, we're telling them about it. And those disclosures get put into a disclosure letter that sits alongside the investment agreement. It'll usually be in a kind of table form that tells them all of those facts. and there'll be a disclosure bundle of documents that sits alongside that. So there's usually a raft of documents. For example, there's usually a disclosure that says that you've disclosed all of the remuneration and details of your employees, so there'll be a spreadsheet that gets attached. There might be one that's asking you to disclose material contract, so that'll be attached. Luckily, the days when I was a trainee of actually compiling a paper bundle of all of those and physically attaching it to a disclosure letter are long gone. So that usually gets compiled electronically and then sent to the investors. No, the only document that's publicly available is the articles and any written resolutions and forms that you need to file with Companies House, but your investment agreement and the disclosure letter won't be seen by anyone else but your shareholders and the investors. And it's a good point, actually, because the disclosure letter particularly is something, because if you've got any skeletons or issues, the disclosure letters where they'll be set out, so you don't really want anybody else seeing that. And I think it's worth saying, actually, that unfortunately that's probably the part of the investment process that founders particularly will find the most tedious, because the process involves reading every single line of every single warranty, thinking, is that true or not? And if it's not true, making the disclosure. So it's quite a sort of lengthy and time consuming process. Yeah, so I think the easiest one for me is usually in fact, there'll always be a warranty which says the company is in no active litigation. And if actually your company is in the middle of a massive court case and you're suing someone or you're being sued, what you would say in the disclosure letter is, the warranty is not true because the company is in the middle of a court case with X, and then you disclose all of the details.
It'll depend on the warranty, because it might be that the company owns all IP outright, but you might license in somebody else's IP, so you don't necessarily own it. You've got rights to it under a license. So you would then say, we don't own it all because we've got a license from the university or we've got a license from somebody else.
So that would maybe common with like a plug and play model where you code in things that you're using lots of different elements from third parties. So that would be the
So it's very much, they'll be focused on, as Sam says, what's the basics of the company. Is your share, we've given you the strategy books and the share register, actually, is it correct? Is it missing a whole bunch of shareholders that you haven't told them about? You've given them a business plan and projections. For the purposes of the investment, there will be warranties about that. You're not promising that you're going to deliver all of that, but what you're saying is that you've acted reasonably in compiling the numbers, that you genuinely believe there's no assumptions that you haven't put down there that would affect it. So that there's another competitor out there or somebody's just about to launch a product and you don't about that, and you've got your hockey stick graph of growth. So you need to make sure all the assumptions are in there. And probably one of the most common things we see is that you've got this business plan, it never goes according to plan. The minute you've put it out and you've started working on it, something comes out of left field and you have to adjust and change course. But yeah, you just go through all of your warranties. Things like all of your employees have got IP assignment rights in their contracts. They suddenly discover, because you've been bootstrapped, actually it's missing that. So you then have to change your contract. So going forward, it has it in, and they might then want you to go around and collect anybody that's got key development as part of your history. They might want you to get an IP assignment from then, and that then forms part of your disclosure bundle and securing your IP going forward. So the lawyers will take you through all of the questions and prod you and say, what about this? Have you thought about that? Do you have this? Because we've seen most things before. Yeah,
and that's something that, as you say, Anna, we would usually work through with an investee company, and it would be tedious, but it usually is a case of one of us actually reading the warranty to you and saying, is that true? And it is something that needs to be taken very seriously, and also you need to recognise that it's completely separate from the diligence process. So often the big gripe we get from founders is, I've already answered all these questions because we did diligence, but actually it's a completely separate process. So you almost need to do it again. And although I'm telling you to take it seriously, there's also an incentive to do that, because investors will usually require that the founders give the warranties and they'll be personally liable for any breach of warranty. And although we'll usually cap their liability, it's usually kind of 1.5, 2 times the salary. And that's so that investors know that, okay, the founder knows they're on the hook for a couple of times their salary if there's a claim. So they're going to do it properly, because for them, it can be as much of an information gathering exercise as anything else, depending how much DD they've done.
Yeah, and probably overriding that, the investor is generally not asking for warranties to be able to sue you the next day. That's not their intention. They want you to take it seriously because there is personal liability there. They recognise they're investing in you, and you're the one who's going to deliver the return for them. But it's a process that you need to kind of be absolutely on top of. It's one of the biggest protections that you've got in terms of the exercise, and actually sometimes it's quite good to kind of go through that exercise. You may have a to-do list afterwards, and some of the stuff they might want fixed, but you will then fix it afterwards, and you'll have 3 months to do this or 6 months to do that, or we want you to change this term, so that it can then evolve into your investment documents.
Yeah.
So having a solicitor look over all these things, how much generally did that cost the founder?
It will very much depend on the amount of money that you're raising, the firms that you do you use. So there isn't a hard and fast rule of it's X pounds, and it depends on the nature. It will cost something. It depends on the nature of the investment as well, and how complicated it is, or it's straightforward and everything else. So
minimum.
It's difficult to say what that minimum or maximum would be, but the lawyers would sit down with you and talk through what that's going to cost at the time, and that gets built into your into your plan.
Yeah, and usually those fees and costs, you would get a scope and a quote from a law firm, and then those fees and costs will be built into that preparation stage, which Anne had mentioned earlier, which was how much money do we need to raise, because usually there's an acknowledgement that those fees get paid from the investment amounts at completion. And that'll be something that will be built into the investment agreement that all the parties will agree to. So that would just get factored into the amount of money that you would need to raise.
All of that stuff, investors control.
Mm-hmm.
Position, there was no money to go and seek any kind of advice.
Okay.
So maybe so that what's that bridge?
Yeah, that's where we'd be looking to jump in and kind of, yeah. Yeah.
Yeah. It's certainly I mean, there'll be all sorts of costs. You might have accounting costs or tax costs doing clearances and that sort of stuff, but it is very often money well spent, because it saves you from a problem in the future, or there's a term in it that the lawyers recognise that actually that's going to cause a problem. We'll probably come on to a couple of them in a minute, but then you might end up losing more of the company without realising that that's what could happen in a future investment. So yeah, you can always look at the scope of what you need and focus it on different things. And it depends how much the company can do itself, and what skills you've got within that to balance out some of the costs. But and there will be a cost to it.
Really on your naive. If it's start definitely. And watch.
Yeah, and I guess that's why we like to get involved with companies at an early stage, so that we can support them, because I think as soon as an investor sees if you are somebody that hasn't appointed lawyers, then, as you say, if they're praying, then it's an easy mark. But yeah.
Okay,
right.
Next one. We're
conscious of time. Employee incentive arrangements. So I think what we've looked at here are really the core documents from an investment perspective. You might also see employee incentive arrangements being put in place at the point of completion. So that might include option agreements for the founders or key employees. And it will also usually include all of the parties agreeing to the creation of an option pool, so that the directors have the ability to incentivize employees through the use of equity and options in the future. And lastly, ancillary documents and consents. So alongside these investment documents, there'll be a raft of ancillary documents. So at bare minimum, We're looking at board minutes to record the directors approving the investment. We're looking at written resolutions of the members to approve the issue of the shares and adoption of the articles, share certificates and company's house forms. But also, if you've got an existing investor base, you might need to get the consent of the investors to taking the investment too. But those are fairly mechanical documents that usually the lawyers would just draft and agree between them. So those are the main transaction documents. So suffice to say, it's only really in a formal investment process, once you've got these documents drafted, negotiated and agreed, that you'll be ready to actually take the investment. Okay, so two things to look at left. The first being founder and management pinch points and issues to be alive to. Just conscious of time, Anna. We can
and this is where we might get a bit of jargon like, but these are some of the things that you might negotiate, and some where it has an impact further down the line. You might hear participating preference shares. We talked about the investors getting a return on their investment. Preference shares are one route. They usually are there if the company is going to be kind of cash profit generative, and they'll take dividends out, and they come out. That return comes out first before anyone else. Quite often you'll have liquidation multiples or exit preferences. And that means then that the investor is saying, my money needs to come back first before anyone else. So they've invested £1 million, you sell the company for £5 million. That first $1 million goes to the investors, and then the rest of the $4 million gets divvied up between the investors and the management, or some other type of return. But there usually is a priority that goes back to the investors. So they get their money or a multiple of their money back first before the management gets a return, or there's a hurdle that you have to hit in terms of valuation before some people get value. You have to watch that very carefully in terms of if you've got sort of EIS, SEIS investors, because these sorts of returns can impact on if the person who's asking for that return is looking for that type of investment, it can prejudice the investment. So there's a bit of a balancing act for the investors as well in relation to that. But yeah, it usually means that there's some element of the deal and the documents that you're negotiating that means the investor gets something back first.
Yeah. Second point there, anti-dilution provisions. So really at a high level, investors will want to make sure that they don't suffer if you subsequently do an investment round that's at a lower price than they invested at. So the purpose of the anti-dilution provisions will be in effect to make them whole and make it as if they'd invested at that lower price at their initial round. And the way that happens is, in effect, there's a calculation and more shares get issued to them. So really the flag there is just to make sure that if you get confronted with these, that you're comfortable with how they work and you're comfortable really with the valuation that you've put on your business and that they're investing in, and that in the future, you're confident that there's not going to be an investment round that's at a lower price.
Leaver provisions and restrictive covenants. Restrictive covenants, a concept you probably are familiar with. If you're involved in a company, your employment contract will say if you leave, you're not allowed to act in competition with the business. You can't poach other employees. You can't steal clients. You can't interfere with the business. As part of these investments, you will typically give similar restrictive covenants directly to the investors. And that means that the investors would have the right to enforce them. They don't need to go through the company to enforce them. And usually if you're paid effectively, or the company is paid an investment and you've agreed to give those restrictive covenants, the court look at them slightly differently to employment ones. And they're a bit more enforceable than employment restrictive covenants. So that's something that you will be asked for in your investment documents. Leaver provisions, they'll be in your articles of association. Typically, you will have shares as a founder of the business. And this is looking at what happens if you leave the business at some point in the future, whether it's on your terms, whether it's on the terms of the investors. What happens when you leave to your shares? Leaver provisions will set out circumstances when you have to give up your shares or give up a portion of your shares up. They might be sold for different prices. If you're what's called a good leaver, so you've left on good terms, then you'll get market value back for the shares. If you've been bad, you've been sacked, summarily dismissed, then they'll usually take the shares back for nominal value. They're kind of very heavily negotiated, and there's a real balance because you've invested in the company, you've invested cash, time, effort. You still want to get a return, even if you're not there at the end for an exit. And then that's being balanced by the investor's desire for somebody who's gone, perhaps on bad terms, not to be a blocker future investment rounds if you've got a big chunk of shares. Sometimes you get to keep some or all of your shares, but they get disenfranchised. So it means that you don't then get to vote on further investment rounds. But if there's a sale, you get your value back on those circumstances. So investors are wanting you to be in the business, want to stay there. So there's usually, you have to be there for at least a period. And if you're not there for a period of time, then they scale back some of the shares, and the longer you're there, the more you get to sort of keep. They can be quite complicated and quite emotive as part of the investment. But in most investments, you will have some circumstances that the investors will want the shares back, so that they're not a blocker. And actually also so that there's some more shares available for someone who's going to come in and replace you, because then otherwise the investors get diluted more, and that impacts on their investment. So there's a real balancing act in terms of lever provisions, but it's something to be aware of. You need to look very carefully at the circumstances for when you have to give up some shares, or when you lose some of the voting rights in those shares, and how much value you can retain if you do leave. Obviously, everybody's wanting to be there until the end, until you've got your exit, but circumstances change. You might move on. So your own circumstances might change, or the management team needs more people coming in, and you go to a different role. So there's all sorts of reasons for that happening, but they're one of the key things to be negotiated.
Yep. So pay to play, can you keep up? I think the flag is here that each time you do an investment round and new shares are issued, as founders, it's likely that you'll be diluted. I don't think people really expect founders to be investing cash at the same time or at the same rate as the investors. So just need to be very wary of not giving away too much equity too soon. Be cognizant of the fact that it's likely you'll have to do multiple investment rounds. So just have that in mind when you're deciding or you're agreeing valuation with investors.
And that's where your share option scheme also comes in, and investors recognise that as founders get diluted, you still need to be incentivised. So options for staff that don't have any equity stakes, and also the management team need to keep being incentivised. So some of the options will quite often be used for them too. Yep. Widening of the investor base and director consent matters. As we talked about, when you get investment, there'll be a series of conditions that are attached to that, and you'll not be able to do certain things without getting investor consent. Most common ones, you can't issue any more shares or transfer shares in the company other than in specific circumstances without getting investor consent. Can't go and buy another company. You can't buy a building. You can't take on very expensive employees. What about litigation? So there'll be a whole series of things that you have to go and get their permission to do first. And the wider you have your investor base, the more people who have got a say in that, you will have to get that consent process. Sometimes the directors have got some things that they can consent to. Sometimes it's the investors that need to consent to it. And you can have different proportions and different groups of investors for different things, because some investors will have, on these three matters, I always need to get consent as one of my regulatory requirements, that I consent to this. So you might have that one investor consenting to these three things, but the wider group is, 65% of the investors need to say yes to this, or, it's a higher percentage. And some of them will have kind of drag along and tag along, which isn't on the list there, but that's a mechanism for, if a group of shareholders agree that they want to sell the business, they can force everybody else to sell. And usually the investors have a consent to that process as well. And you want it to be high enough that the investors can't sell the business without the founders agreeing to it, and low enough so that you've got the right grouping of people who are in control and can make the decisions. And, a couple of straggled small shareholders can't block a sort of sales process. So there'll be all sorts of consent mechanisms that are built in that you need to be aware of for future investment.
Manage that.
There'll be different levels. So sometimes there will be board decisions. Sometimes they'll say that the investor director can sign for the investors. The investors will have their own internal processes, and they may not be able to have the director sign up to all of them. But yeah, you definitely want to be managing that process, because the last thing you want to do is have a 3-week delay because you've got to go and get someone who's gone off to the Bahamas and they're investing somewhere else. And it's a really difficult process to get. So understand their consent mechanisms and who can give it and how they give it. as part of your investment process is probably kind of a good thing to think about.
Yeah, and often it might actually be two lists. So there'll be a list of things that the investor directors need to consent to and a list of things that investors need to consent to. So the investor directors, it might be stuff like CapEx over 5k or something. But if you want to go and buy a building, as Anna said, or something else, then you need to get investor consent. So it's often the negotiation is what fits into what bucket. Yeah.
Yeah. Yeah.
That's an area where investors feel they can micromanage it.
Yeah. Yeah, that's right. So that list is them balancing, them protecting their investment from you being overly burdened by being micromanaged on that. So that list is quite important to have a look at the time and understand if it's in the budget and they've agreed it in the budget, then that's kind of an approval for some things. So, but yeah.
Money buys and brains.
Yeah, and there's
the consent process.
Yeah, I mean, there's usually thresholds, monetary thresholds that get negotiated. For example, they might say, "Look, we don't want you hiring anyone over 50k," and you might say, "Come on, go for 100," but they don't want you running off and hiring a 500k CEO, you know. Okay, board composition and control. I think we've kind of touched on that already, but remembering that the board of directors has responsibility for the day-to-day activities of the company and that they act by a majority, it's important to get alignment with the investors on what the board composition looks like, making sure that the founders and key individuals in effect, particularly in the early stages, control the board and investors don't. Investors will often look for an enshrined right to be a director or to appoint a director to the board for so long as they hold shares. So that's something that usually gets negotiated depending how many investors you've got and how many would like that right. But if you don't give everyone the right to be a director, you could also give people the right to appoint observers to the board so they can send people along to observe, not vote on any matters or really participate in the meeting, but observe and report back to them. So yeah, directors and observer rights are something that's hotly negotiated usually.
Option pool dilution we've talked about before. The only other thing we would add to that is you'll usually agree, typical 10% option pool. So it's of the share capital of the company, up to 10% you can issue to employees. You want to make sure that that's included within your share cap table in the dilution for the investors. That takes account of that when you're doing your number crunching, and you don't end up the management of bearing all of the risk of dilution. So, but certainly you want to negotiate what you've got available, and that will typically then automatically increase as you do further funding rounds. So if you've got 10% and you've got $1 million invested, the next time you get 5 million invested, you've still got a 10% option pool, but it's more shares because there's a bigger issued share capital, but you'll need to get your shareholders to approve the issue of those shares going forward. But you want to kind of enshrine that option pool at the beginning for the employees. Yeah.
Could it be only for the employees, or it could be for others as well?
It can be for whoever you agree. There'll be different there'll be tax efficient schemes that you can get for employees to grant options. You might say that actually I want to incentivize this person who's key for the business. There may be a consultant or they've involved. So yeah, you can give options to anyone. There'll be different tax consequences for who gets those options. And quite often you'll have to agree who you give the options to with your investors, or they might say it's up to you to grant the options, but there'll usually be some element of input, but it doesn't necessarily need to be just employees. It can be wider than that.
And lastly, the product development and commercialization. So I think we touched on this earlier, which is really making sure you've got alignment with your investors and remembering that as soon as they've invested in your company, the reason that they're doing that is, although they may like you, it's to get a return. And they'll be expecting you to commercialize your product and your business as quickly as possible and in accordance with the timeframes that they're expecting. So just make sure they're aligned, because I think there is a tendency for the founders to want to develop their products so that they're perfect in their eyes. But from the investor's perspective, they don't want the perfect being the enemy of the good, and they want their cash returns. So yeah, it's just making sure you're aligned on that piece. So
it might not be totally perfect, but they want you to launch and kind of get the product out there rather than lose the opportunity and the advantage because someone else has got their got there first. So it's balancing that. It tends to be scientists tend to be probably more guilty of that than others. But that's a key thing to agree with your investors.
Yeah. So if we've got time, we've just got one more slide if we're okay for 5 minutes or so. So we're going to play, if you can indulge me a wee bit, just a loose game of common pitfall bingo. So we've just got a bunch of common pitfalls for founders. I've got them in the sheet in front of me, but it would just be useful to hear from you whether there's things that you've experienced that haven't gone well in investment rounds in the past, or things you can foresee going badly. I don't know if anyone's got any experience of when it's not gone quite so well.
Preferred for our online audience.
Oh,
yeah.
Underestimating the timescale. Underestimating the timescale for a deal to be done.
Yeah, I think that's absolutely correct. One, it will take longer to get all of the documentation agreed. And I would also take with a pinch of salt, the investors say, yep, we can do this in 2 weeks, we can do this in 2 months. It will take longer. So certainly plan for it taking longer than you think it might do, and the investors say that they can do it in, because that will impact on your business, it'll impact on your cash runway, and when you fall off the end of a cliff if you've kind of got to that point.
6 months.
I mean that's what's one. You can be done faster than that, but if it's a first investment, it certainly can take at least half that time. If not the full 6 months. Any other thoughts?
Difficulties in convincing the investors?
Yeah, certainly one that's, it's making sure that they're bought into your product and your vision. That's good. Yep, we can do. Yep. And quite often we will, if we act for investors as well, they'll have different things, but yeah, we can try and match people. We certainly got lots of contacts, so certainly with clients to speak to us, we can say you might think of speaking to so and so, and make introductions for people. Yeah. Any other thoughts on it, Jordan? Yeah, that's a really good point, actually. And usually particularly if you've got tight timescales and your cash runway is not particularly long, you should always try and have a backup plan of, this is the ideal happy path of this investor for this investment amount, but what happens if that doesn't quite go the way we thought it would? And that could come in a variety of forms. Sometimes it might be other investors you've got lined up that will take, that'll give you slightly less investment, maybe on slightly worse terms, but at least it's there. So it's important to just think through a plan B. And it's also important to look not just, usually your investment is part of a package. There's usually grants that are available, award schemes that you can get funding under, R&D tax credits and things like that. The company, if you do lots of kind of research and development, then you can get money back from that, or kind of games tax, breaks. So there are a variety of different resources, or you might have somebody that will tide you over, or will do an advance subscription in advance of ticking all the boxes for everyone else. But it's important to make sure you've thought about what happens if it doesn't quite go according to plan.
Yeah. I've put forward some figures to investors in the past, but what they tend to do is rip them up and go about 10 below. Yeah, valuation is... They're just not going to buy it. Yeah. But it seems to be that they're going to make up the figures, but they want you to make the figures up. Yeah. Yeah. I think best of both worlds. Palatable for my pocket. Yeah. Yeah. I mean, they don't want to give you the money that you actually require. Yeah, and they'll go into negotiation school, so they'll start at a tenth down. What you ask them. So yeah, it's yeah, it is. It's you don't need that much money. And that kind of leads. Yeah, and that kind of leads on to another pitfall, because you can be on the fundraising treadmill. You never quite raise enough money.
that you want, or it takes longer to have raised the money, and you're on to your next stage. You've got you get 3 months break between your funding rounds, and then you have to start the process all over again. So it comes down to what you're looking to raise, how much they're prepared to give you, how they might tranche it. But it's very difficult, and investors will typically have the upper hand because they're the ones with the cash and you're the one who's looking for the cash. So if you can get that sort of competitive tension between investors, if you can, then that does help speed things along and improve valuations. And just keeping your eye on the market. The market, who's sold for what multiple, have they been sold at, what do you know, and try and use that as negotiation, because that's where they start from. They'll be looking at their other investments in similar businesses.
As much as you look at the market.
Yeah. Dave?
Yeah, that's it. Dave?
Scale it in a way that might not be possible, or they're not the investor. Get to a successful outcome, and their driver really is to make money, help them make money. So the valuation piece can be a really tricky one to get right. But if the investors and the founders in the business that they're investing all aligned about what the end point is, everyone should be pointing in the right direction. It should be a good result for everybody. But I think that just goes to emphasize the point raised by Andrew and Sam at the beginning, which is that preparation is really key. Understanding who your investor is really key. Making sure you've got a line code is really key. It's also going to help with all of those conversations. So whatever the right amount of money is for you to raise, or the investor thinks that you need to raise or not, if the foundation of that conversation are in the right place, hopefully that gets you the right investment.
Any other thoughts, or we'll run through the
we just put them up.
Kind of shorter time. So
that was our list. I think we just about got a bingo there covering them.
The raising too much or too little. Too much means you've got dilution. Too little means you're on that treadmill. And again, giving up too much, the company come back down to the valuation. This is probably not going to be the only round of investment that you do. So it all comes down to where your starting point is.
Yeah, and I think that links into having too many investors point as well. You don't want to end up with a cap table of thousands. It just makes your life extremely difficult going forward from a corporate and a governance point of view.
And sort of raising funds too early, again, if you're raising funds too early, your valuation is lower, you're giving away more of the company. So how can you manage to keep going until it's a point where you can start balancing out that a bit better?
And is it quite normal for investors when they're coming into the company just to say all these shares are getting diluted straight away?
Well, that will be a factor of it. When you issue any shares, whether it's when you exercise options or your investor comes in, it will dilute everyone else. And what you're looking at is, what is the value that you're placing on your business? What are they going to pay you, and for what percentage of the business? And that then kind of generates how much everybody then gets diluted by. So it's all a factor. But as soon as you issue any more shares, or you grant options or warrants, then everybody gets diluted, but the investors should be trying to.
Starts like 100, and then they come in and say, no, it's 20,000 shares.
Yeah. And
cool.
It's and it all comes down to the valuation of the business. So you're saying that you need £1 million, and the investor says, I'm only valuing you £1 million at the moment, which means that they've suddenly got 50% of the business, because their $1 million plus your existing $1 million gives you a £2 million valuation. So that drives how many shares that are issued. So it's that kind of, what do you need, and what value are they placing on the business, and how does that then translate into how much of the company that you're giving away. Picking up some other ones, kind of taking your eye off the ball. As we said at the beginning, it will be time consuming to do this sort of thing, and you end up not focusing on the business. So you need to make sure that the team around you are carrying on doing what you're doing, because if the business starts dipping, then you might end up with a renegotiation of the valuation at the end because you haven't met the budgets and the targets that you said that you were going to.
We come
investors.
What's that?
Big ego.
Failing to know your investors. Yep. Unless anyone wants us to talk about any of the other ones that are on there, happy to take any other questions over lunch.
Plan B.
Plan B, well, that is take less money. You plan to open 3 new offices. You might only need to open 1 office. You can't scale up your sales team quite as quickly as you've got budgeted. So you're going to eke out the cash that you've got for longer. You've got a rich neighbour who's happy to stick in an amount of money that will keep you going, or somebody that's not got a condition that you raise, £1 million, they'll give you if you've only raised $500,000. So, you can eke it out until you get your R&D tax credit repaid. So there's different ways of doing it. It's not easy, and you're trying to make that cash elastic. But it's important to think where else, or how can you adjust your plan to meet the money you're actually going to raise and get yourself in a better position, then go back round again and ask and look for more when you've hit a particular criteria. I'd say happy to answer any questions over lunch. I hope you found that informative. But as I say, we'll speak over lunch, and if anyone has any other questions, then we can speak later at the office hours. Thank you very much.
Thank you very, very much. And then Sam, and also a big thank you to Skyscanner. This is the reason this event was made possible.